Here we examine the relative importance of the activities that make up United Kingdom Gross Domestic Product, GDP. There are three methods of calculating GDP, and they should all produce the same result. The expenditure approach. This adds up all the money spent on final goods and services. This expenditure falls into the following categories: consumption, capital expenditure and net inventory building, government expenditure, and net exports. The money which government pays as benefits does not count as expenditure, but counts as a transfer payment. The income approach. This adds up all the income earned from the production of goods and services. This income falls into the following categories: gross wages, including mixed income, imputed owner-occupier rent, earnings before interest, tax, depreciation and amortization, taxes on products and services, and government subsidies of products and services. In the UK, subsidies are insignificant. The output or production approach. This is also known as the value-added approach. This doesn't care about imports and exports. The output approach adds up the extra value each activity adds by deducting from sales revenue the cost of goods and services involved, excluding wages. So this falls into value added and taxes on products and services. The output and expenditure approaches rely on users attributing value to product and services. The inclusion of government taxes on consumption allows the three approaches to produce the same final value in principle. This means that in a high tax economy there is an element of double counting, in that if consumption taxes were to be eliminated by reducing income tax allowances, then GDP would be less. We now look at the income approach. Consumption taxes are shown here and add up to £243 billion per annum. Subsidies on consumption and production add up to £30 billion, mostly to the rail industry. The categories of the income approach are W for wages, R for rent, P for gross operating surplus, and T for consumption taxes less subsidies. These figures are inferred from figures on government websites. The private sector employs about 30 million people full or part-time, and government employs about 6 million people. Pensions to government employees are on top of their state contracted out pension. Government pension contributions are so generous that, according to actuarial calculations, they are 27% of gross government wages. This compares with an average of 5.3% for private sector employers. Government accounts for more than 50% of all pension contributions. UK train drivers are paid more than senior airline pilots. Pension contributions form part of GDP, but pension payments do not. GDP uses the gross operating surplus, which is profit before interest, depreciation, and amortization and tax is deducted. Much of commercial net interest paid is paid on corporate bonds. This figure is the most difficult to infer. Consumer interest paid to banks does not contribute to GDP, but bank profits, of course, do. UK private debt is about £2.3 trillion, 75% of annual GDP. Of this, 1.7 trillion is owner-occupier debt, that is mortgages. Corporate bonds are not included in this total. In the transcript, you can find the latest annual interest and depreciation and amortization figures for all 72 FTSE 100 companies which are domiciled in the UK. The FTSE 100 is 80% of the market capitalisation of public limited companies. This informs the estimates I give here. D&A, that's depreciation and amortization, includes amortization of goodwill. Illegal earnings relate only to prostitution and drug dealing. All other earnings not reported to government do not form part of GDP. More on imputed owner-occupier rent later. The ONS bundles self-employed earnings and unincorporated rent together as mixed income. One aspect not covered by these calculations is that they do not take account of who benefits from taxable profits. This is balanced by the fact that no account is taken of the benefit UK residents derive from taxable profits of companies domiciled in other countries. This latter figure is supposedly included in gross national income, which comprehensively attributes taxable profits and dividends. The effect of this is that a country which permits inward foreign investment will have a higher GDP without necessarily benefiting nationals in respect of the after-tax profits. This chart shows the expenditure and income approaches concentrically. Now consider the output approach. In this video, I will attempt to allocate GDP to various industries. The Office for National Statistics uses SIC codes to classify economic activity. I could not find UK GDP broken down into SIC codes. These are the foremost themes. Very few industries are more than 2% of GDP, and the ownership of industries substantially affects GDP. I have categorized the economic activities into those that can be found on the stock market and those that are not easy to invest in. You can invest in about 60% of the economy. These are the 16 largest non-investable industries, and these are the 13 largest investable industries. The figures below do not properly separate physical manufacturing from services because some services, such as for example dentistry, include a significant manufacturing component, and because some manufacturing is too specialist to have its own category. However, all physical processes are likely less than 16% of UK GDP, with contributions shown here. This adds up to 14.5%. A big part of financial company income is UK exports. Generally, my output approach figures do not account for the ownership of the industries. This effect can be quite large, and in respect of this, some figures are of course wrong. The second column in the data is an estimate of the growth rate of these industries. It is clear that there are few engines of growth in UK GDP, and real terms growth of more than say 1.5% is unlikely. For example, advertising is shown as 2% and includes digital advertising, but a big portion of the industry is foreign owned, and so the figure is probably overstated and imports exceed exports. Note that the UK software market is estimated at 31 billion, which is over 1% of GDP. To gain perspective on this, know that UK company Sage has revenue of 0.1% of GDP. Possibly 75% of this accrues to UK GDP. For example, cloud storage is shown as 1.5%, and whilst consumers and companies spend this, the vast majority of that is imports. Because there is so much overlap of content creation, digital services and advertising, it is possibly not meaningful to try and categorize these activities. The breakdown is shown here. The activities which it is difficult to invest in form about 40% of the economy. What brings about a high GDP per person? If the GDP of high GDP countries were to be adjusted to discount the following: the contribution of mineral extraction, the high price of certain goods and services, the portion which accrues to ultra high worth people, and the contribution of consumption taxes, then variations between the advanced economies are actually quite small. Countries which suffer the effects of natural disasters, crime, high land values, or financing armed forces will have higher GDP. Note that oil, gas, and mineral products account for only 0.4% of UK GDP. For comparison, note that for the USA this figure is 4%. By value, 75% of USA mineral production is oil. Carbon-based fuels are the foundation of the wealth of most large countries. The NHS is 9% of GDP, and total health GDP is 9.7%. In the USA, it is 18%. Obviously, most of this variation is accounted for by the difference in the price attached. An example of this is the monthly price of the weight loss treatment Wegovy. In the UK, it is £89 per month. In the USA, it is £1,000 sterling per month. It is instructive to consider boosts to USA GDP which either confer questionable benefit or are due to geographical circumstance. Health, 9% due to prices. Hydrocarbons, 3.6% due to geology. Motor vehicle production, 1.5% due to bigger cars and distances. Building, 0.5% due to natural disasters. Armed forces, 1% due to a bigger military. Prisons and justice, 0.2% due to higher incarceration, and this adds up to 15.8%. The USA economy benefits from digital services as follows. Exports 2.4% and internally 1.5%. In the economy, data is the new oil. The USA GDP per person is nearly twice the size of the UK GDP per person. Back to the UK. Now consider the value of dwelling houses. Rents for commercial properties are mostly allocated to the industries which use them. Only just behind health, the next category is imputed owner-occupied rent at 8.41% of GDP. When the occupier owns a house, then the benefit that is derived from the house is included in GDP, even though no money changes hands. There are 16 million owner-occupied houses in the UK, and for 2024 the imputed owner-occupied rent was 185 billion. This means that the average for a house is 11,560. The benefit is calculated by taking the value of the house and multiplying it by the average yield for the rental market. The average net yield should be used and not the average gross yield. This avoids double counting maintenance and insurance activity. Typical UK gross and net yields are about 7% and 5.2%. 11,560 divided by 0.052 is 222,000, which is below the average house price of 300,000. Possibly the valuation office is behind with its valuations, but there is possibly political pressure to prevent this category from rising too much. Actually, there is little variation in house prices in advanced economies. For example, the USA average is £380,000, whilst the UK average is £300,000. This difference is probably mostly down to size. The average house price in Japan is £260,000, despite the fact that 9 million homes are derelict. The breakdown of property rentals is as follows. Government statistics show the number of rental dwellings at 9.4 million and the average rent at 1,330 per month. This gives this breakdown in billion pounds. Person landlords 558, public sector 20.8, other incorporated landlords 69, and purpose-built student rooms 7, giving a total of 154.8 billion. It is also clear that a big fall in property values would reduce GDP by a lot. Such a change would not affect our prosperity at all. We would find it much easier to change jobs and live closer to our workplaces, but GDP measures that not at all. In economics, the term economic rent is the income earned by a factor of production, like land, labour or capital, that exceeds the minimum amount needed to keep it in its current use, known as its transfer earnings. Be aware that economic rent on land is included in GDP. They don't make land anymore, so its value keeps rising. Often, the value of just living in our houses exceeds the income to the household. GDP per person got bigger partly because the population grew. Including economic rent on land informs those who want to invest in the country, but effectively misleads those who don't own land. My guess is that excluding economic rent from GDP was never considered because it would have been too difficult. Anomalies. This is a list of ways in which GNI, that's gross national income, and GDP are misleading. These are ways in which GNI is less than it could be and GDP is more than it could be. Regarding GDP, China's GDP is low because its taxes on consumption are low. Ireland's GDP is boosted by the profits of international companies, but only 15% of this value benefits citizens. Immigration boosts GDP because it increases the price of houses. The contribution of capital to GDP is triple counted. That is, its cost, the depreciation of it, and the interest financing it. In a high inflation environment, GDP is inflated because nominal interest rates are high. Bear in mind that we are considering gross domestic product and not net domestic product, which is GDP minus amortization and depreciation. South Korea buys very expensive EUV technology from ASML, which gives rise to very high depreciation, which boosts their GDP but not their net earnings. The building of brands using advertising and the developing of technology contributes to GDP, and the use of these contributes to GDP, and thus this is double counting, which net domestic product excludes. The organization responsible for producing GDP figures is the Office for National Statistics, ONS. I note that their public-facing websites include no detailed description of the methods used. I have had to rely on other sources to derive this presentation. There is also no readily available public access to the datasets which they have. I am tempted to believe that the ONS has this siege mentality because they have no confidence in the quality of their figures. Now consider some examples. Interest rates go down and thus shares go up. Persons buys shares. Interest rates go up. Shares go down. Person sells shares to investment company. And repeat. Investment companies do not pay tax on their capital gains in shares, so the capital gains and losses do not feature in the calculations, but the wages of the investment company do contribute to GDP. This boosts the income approach. However, when the capital gains accrue to the person, the expenditure approach will not reflect that because the boost to consumption is mostly offset by the boost to imports. These private capital gains losses should play no part in GDP, but professional gains do contribute. You could make the argument that the interest rate cycle is the engine which transfers wealth to governments, and that the wages of the investment company mitigate that. Viewed this way, then, just as insurance service mitigates the effects of natural disasters, an investment service mitigates the effects of government gouging using inflation. Example 2. Palantir invests $100 billion in a robot which will take over the world. Palantir shares rise by $200 billion. Investment companies pay wages which boost GDP. Investment companies pay dividends which do not boost GDP. The robot fails and Palantir shares fall by $200 billion. The investment company shares fall by $200 billion. All that activity benefited nobody, but boosted GDP by, say, $120 billion. You could say that GDP includes vaporware. Example 3. A food manufacturer builds a brand by spending £100 million on advertising. The brand is sold for £100 million. The goodwill is amortized by £100 million. GDP is boosted by £100 million. But it is hard to argue that production was more than the $100 million, which is the premium which consumers paid. but in fact GDP was boosted by £200 million. Final example. Ireland has a low corporation tax rate to encourage companies to tax their profits there. This accounts for about 45% of Irish GDP. The overall effect is that advanced economies have higher GDPs, but a large proportion of that higher number does not benefit the nationals of that country. Hopefully, you now understand gross domestic product better. You might well be thinking that GDP is no more than a very imperfect measure of how well the government can finance its activities.